was a tough day on Wall Street today. The S&P 500 falling nearly 2% with energy, financials, technology, industrials all leading the way lower. Let's get more on what drove today's sell-off. Bob Pisani is at the New York Stock Exchange. Bob.
Hello, Melissa. Let's call it a combination of additional tariff worries and speculation on the health of the U.S. consumer, which is the engine of global growth right now. Part of the problem with parsing the state of the consumer is very confusing data. So, for example, the movement of two big-ticket consumer items, housing and autos, they don't seem to be correlated right now. Housing's been very strong on lower rates. Lennar had terrific numbers today. It hit a new high. But autos have not been great. Ford had disappointing third-quarter car sales and was down today. Now, home building stocks are up 16% in the past 3 months. Look at this. Auto manufacturers, this is what I'm talking about, down nearly 12%, going in the other direction. So here's four things traders are looking for in the next couple of weeks. First and second, any signs of a slowdown in the consumer, starting with first, the Friday jobs report, where expectations are for a gain of 145,000 jobs. And second, the markets are watching for any kind of decline, significant decline in consumer leaders this year. And it's been very clear what those leaders have been. Costco, Home Depot, Starbucks, Nike, all of whom are up more than 20% in 2019. By a significant decline, I mean 15 to 20% from those highs. That would be notable. So far, only Starbucks is showing some signs of weakness. Third, what I'd say is a technical breakdown. Right now, any significant break below the 200-day moving average for the S&P 500, 2835, and we're still almost 60 points away from that. And finally, near-term fourth quarter guidance from some of the significant global leaders. I would start with J.P. Morgan. That would be October 15th. So far, no signs of any earnings recession this year. Back to you, Melissa.
All right. Thank you, Bob. Bob Pisani at the New York Stock Exchange. Steve, I know you probably were watching the home builders as well as the auto stocks.
So I'm still in Lennar. I've been in that one. It's been a winning trade. It's up 47%. The real winner has been KB Homes. That's up 75% year to date. Pulte is up 39 or somewhere thereabouts. This has been a winning trade. It's been in direct correlation to interest rates. So if interest rates do start to tick up somehow, some way around the Fed, you have to watch out with this segment that has already been so beneficial to a lot of investors.
In terms of the consumer, though, I mean, I think that there are probably just as many data points on the earnings side right now. I know it's very, very early that could indicate a strong consumer as there are for a weak consumer.
Yeah, I mean, we've heard strong consumer from a number of companies, especially people like Nike and discretionary. Discretionary is not dead. But, you know, look, let's check this payroll tomorrow. I mean, if wage gains start to fall below kind of 3.2, 3.3%, you know, you start to wonder how sustainable it is. Look, at some point, companies cannot continue to be hiring people. Look at some of the industrial sectors. The auto companies tell you what could happen to jobs. We're seeing it in steel. The steel industry has been ravaged. So, you know, be careful.
All right. Well, the Dow closed merely 151 points away from wiping all of its second and third quarter gains today. And our next guest is sharing Wall Street's recession concerns. Mike Gapen is Barclays head of U.S. economic research. Mike, welcome to the show.
Thank you.
So what is your probability now of recession?
It's 25 to 30% over the next 4 quarters.
Is that high?
It's higher than normal. So kind of in a regular expansion phase, you'd think 5 to 10% per year. Like unconditional probability. But what's concerning us is the slowdown in the labor market. So to your point, if employment growth is slowing and we've got soft manufacturing and hours worked are slow, it's going to mean less aggregate income growth, less ability to support consumption. They're not lockstep. Just because one slows doesn't necessarily mean the other one follows right away. The savings rate is 8% after all. But you wonder how long can it keep up. So we do expect private consumption growth to slow and the economy to remain at trend, if not a little bit below. The first half of the year we think was a manufacturing trade slowdown. The second half of the year we think will be a consumer focus.
So what are some of the other leading indicators that you would look at that maybe give us a hint of what's coming?
Well, I mean, honestly, for us, it's all about employment. The 3 leading indicators would be employment, employment, and employment. That's about as funny as I get as an economist. Mainly just it's about the best I do. Mainly just because the labor market has the highest signal to noise content. It sends you kind of the most robust signal. And historically, households won't be as comfortable spending if income and employment prospects look bleaker. So to your point, if some of these consumer companies are not getting the earnings, are not doing the hiring, and that persists, then consumption's going to slow down just like business spending did. Doesn't automatically mean a recession, but you have less absorption capacity for what might come next.
So your probability of recession, it compares to about 10% on any other sort of normal quarter, correct? Or
so it's not a tail risk, but certainly not a baseline yet.
So if you're telling us that it's employment going to your number one joke in your repertoire. It's even funnier the more I think about it. But that's the primary determinant of whether or not we're going to be in a recession. What is making that probability go from 10 all the way up to 35% on the outer bounds of your estimate if employment has been relatively good? So what about the number is forcing that probability higher?
I think just a repeat of the same numbers. So the slowdown. So the reported data showed about 210,000 jobs a month last year. Let's call it 160, 165 first half of this year. If we're kind of repeating 100, then over time that builds up. Slower, less employment growth, less aggregate hours worked. So you're just kicking off less income.
Low unemployment rate. It's basically full employment.
Right.
So I'll take that. I guess the question is, why do you think the expansion has been this long? I think it's more of a product that we've been without a recession for this long in the expansion. Why do you think it's been this long? And do you think that we could roll off quicker because it has been so long before we've gotten there?
I think it went this long in part because of how far it fell, and then the slowness and cautiousness in the recovery. Our argument for years has been slow isn't fragile, slow is actually durable. Right? So we were just kind of plodding along in a way that actually was quite resilient. Going forward, though, it doesn't, just because it's been this long doesn't necessarily mean the next one has to be deep, it has to be severe. The difficulty in calling recession risk right now is there don't appear to be obvious overhangs, obvious exuberance, boom bust, a Fed that's looking to tighten a lot. So we have difficulty finding an outright catalyst. But it doesn't appear like there's a lot of an overextended sector ready to course correct, and when it does, you're going to get a very deep recession. So it doesn't automatically mean, since we've grown this long, that the recession has to be deep. There'd be a lot of factors driving that.
Do you think, though, that extremely low interest rates for this long has caused some of those boom busts to sort of even out? I mean, the excesses to get flattened, so you don't have those excesses as we've seen in other cycles?
I think in part we've taken down certain sectors were in recessions at certain points in time. And I also think the regulatory environment probably corralled some of the potential excesses and we've maybe traded lower growth and lower volatile growth for potentially faster growth for a period, but a risk of an overshoot. So I think those are part of the reasons. And maybe policy's just been less effective. There is a zero lower bound story. Monetary policy has less traction in this world, so it took longer to climb out and didn't give us a major overshoot. Okay.
Mike, thanks for coming by.
Thank you.
Good to see you. Mike Gapen.
Well, fascinating stuff by Mike. I think if we start to think about areas where if the consumer does start to first of all, earn less money and start to lose their job, I think the trades that have been most sensitive to this environment have been Home Depot, have been some of the places like Starbucks. Think about the labor costs also that have been fed into a lot of these businesses. And even though there may be less jobs, you actually may see their margins be significant.
You got to mention Starbucks here. July 26th, the stock traded at an all-time high, up 8% after their earnings, after they printed a 7% comp in North America. It was amazing. The stock has literally been down 15% since then. So, the point is things overshoot to the upside. They also have the potential to do so to the downside. That stock has no bid right now. And fundamentals seem great based on the U.S. consumer.